Welcome, it's Blazsik here at Logos and Markets. In this video, we're going to look at the option strategy of a covered call. Again, go to the Logos and Markets website and you could download through the tab at the top, which is going to be Sim Finance. You could download the Excel sheet, the Sim method. If you do it correct, it'll light up green. Best way to learn finance, and I truly believe if you want to know learn this, do the sim method. You can learn it instantly. If you made a mistake, you can see what your mistake is right away rather than waiting till the end. Let's get to the Excel sheet right away. Again, with any option strategies, we want to look at what the strategy is. So this is neutral to moderately bullish on the underlying, expecting a slight price appreciation or stability. The construction of this is we're going to buy the stock and we're going to sell the call. Okay. Buy the stock, sell the call. So remember, a protected put is buy the stock, buy the put. Now we're going to be a seller of the call and we're going to buy the stock. Let's get to the, just like we did before, I'm going to do the current stock price. We'll just stick with $100. We're going to look at the strike price. We're going to say 110 on this call. The premium is going to be just like we did before. So the premium is going to be $3. We're going to look at increments. We want to say the stock price can move up or down, and we're going to say by 5%. Again, you can adjust that any way you want, and this is going to look familiar on all the other videos I've done. So we're going to long the stock. We want to see what the profit loss is. And again, I'm going to start at the top so I can drag it down. Just do it one time. What is my profit loss in the stock? Well, whatever this current stock price is, that's what the value of it today is, right? And then I'm going to say minus the price I paid, and that's the cost of it. So I'm going to hit function F4. I'm going to make that an absolute reference. I don't want the 100 to change. I paid 100, and then I want it to adjust to the stock price. So we'll drag that down, hit Control D. That's going to give us our different profits. And then what we're going to look at is what's the, if we short the call, that's selling the call contract, we're the seller of it, and we want to see what our profit loss on that would be. So we're the seller of the call. So right away, I want you to think about, well, what does that mean? That means I am making the premium. I'm going to put function F4 to freeze it, make it an absolute reference. I'm making that money because I sold it. And then that's going to be plus. Well, if I sold an option, remember that's a minimum function. A minimum function because it's dependent on the buyer of the contract if they exercise it. And I want whatever is less to make this correct, right? 0. People forget zeros all the time. And then you want to think about, well, the call. I think the best way to think about the seller of their function of their profit loss on the call contract. Well, if you bought the call, I have a right to buy it for 110, right? I have a right to buy it at 110. If it goes to 200, the buyer makes the profit of the stock minus the strike. That means it'll be the opposite. For the seller, it's going to be the strike price minus function F4, make sure it's frozen, minus the stock price. So if we're out of the money, we're making the $3, as you can see. And if we're in the money, we owe, that's going to mirror the purchaser of the call. We're going to owe money if it goes up. So now what we can look at, what is our covered call profit loss strategy? So I'm going to go equals. It's going to be the stock price plus the call. We sold the call. So I'm going to drag that down. And there's our profit loss. I'm going to drag it over. And that's what a covered call strategy profit loss looks like. I think it's real important to really understand this is I'm going to hit the filter and I'm going to add in just the stock profit loss. I'm going to apply that. So it's going to look a little weird because it's continuous compounding. So I want to show you what it looks like here is that it kind of protects the losses. It cushions it, right? I'm not losing as much. If I just owned the stock, since I sold the call, I cushion that loss a bit, a cover call. Now you might be thinking it does not look as good as a protective put. However, if you don't think the stock is volatile or you don't think it's going to go way up, look what it's doing here is that it cushions it, right? I should make it different colors here, but the cover call is above that. The stock is the straight line. And then even if you're making money, you're making more money up to a certain point, up to that where it caps it out. In other words, once it hits a certain price, every dollar you're making with the stock, you have to pay the buyer of the call. So it's a 1-for-1. That's why it's a straight line. So it shows you're going to lose a lot, or what you could have made if the stock goes up to $1,000, right? I was like, oh, you could have made a lot. But if you don't think it's going to move that much, you're making more in that range there. It's a little above that. And then if it loses, it kind of gives you a little bit of a cushion of what it is. So go back there. Last part, you can play around with that if you want to look at that. What do I mean by strategy as compared to the stock? How much do we make there? So all I'm saying here, here's the strategy. And I want to know the difference between this minus just the stock price. So I'm going to shift it down. So all I want to show here is what is it compared? If I just buy the stock, in this example, I'm selling the call and the stock. So I'm showing you is that if the stock goes down, you're better off with the strategy. You're $3 more with the strategy. And why are you $3 more? You made $3 on the premium. But it does get to a point that if you own the stock, it would have been a better strategy is just to own the stock. Now, if it goes up, now you're negative 22. So it shows that you could have made a lot more money in that regard. Okay, so that's it. That's a covered call strategy there. And then just to show you down here on the Excel sheet, we have tons of strategies: short strangle, long strangle, straddle, short, long, butterfly, short, long, bull spread, long condor, short condor. So we have tons of strategies. Check them all out. I'll go through all these, and you'll really learn how to do it, and you get very good and efficient of using Excel and typing it in those different functions to make it correct. Again, visit Logos and Markets website. Excel sheets are free, and thanks for listening.